Hi folks, welcome back to the next segment of the Question 5 video, which is going to now focus on the preparation of the consolidated balance sheet. But before we can prepare that consolidated balance sheet, we need to find two critical numbers on that sheet. We need to find consolidated retained earnings at the end of year 6, as well as the value for non-controlling interest at the end of year 6. Now this question that we have, Foxx and Rabb, presents something a little bit interesting in that it gives us a statement of retained earnings. So we actually have an opening balance so we know each separate entity's, Foxx and Rabb's, opening balance of separate entity retained earnings. So what I'm going to do is I'm going to take the opportunity to show you two different ways that you can actually calculate the ending balance of consolidated retained earnings at the end of year 6 for your consolidated balance sheet. So you can use what you learned in your introductory accounting classes and find the consolidated retained earnings at January the 1st, year 6, and add to it Foxx's share of consolidated net income less dividends declared by Foxx to its shareholders. So I'll just make sure that's clear. Consolidated net income. And then let's see how this method would work. As you might recall, this was demonstrated in the textbook too, so we've reviewed it in class, but this is just a different question where you could use it, right? So what do we know? We would take the consolidated retained earnings of Foxx, adjust it, and add it to Rabb's adjusted retained earnings balance. That's typically what we tend to do when we're calculating consolidated retained earnings regardless of date. So if we start at January the 1st, we know that Foxx's separate entity retained earnings from the statements in the question is $153,000. That's at the statement of retained earnings. We also know that Rabb's retained earnings at January 1, year 6 from that same statement of retained earnings is $92,000. But $30,000 of that is acquisition retained earnings. So post-acquisition, or the increase in retained earnings since acquisition for the sub, Rabb, is $62,000. But don't forget, from years 3 all the way to the end of year 5, we would have amortized $5,500, right? If you go back to your Part C, you'll see it there. It's right in there, $5,500 from years 3 to 5. We're not interested in year 6 yet because we're only at January 1, year 6. We're not into actual year 6. So we're only going to the end of year 5, which will take us to January 1, year 6, right? We don't have any impairment losses. You'll remember all the impairment losses were said to have occurred during year 6. So because we're only calculating consolidated retained earnings in this first option, at the beginning of year 6, we're only looking at acquisition differential amortizations that were expensed. That's $5,500. So $62,000 less that $5,500 is going to give us $56,500. But don't forget, we as Foxx can only take our 75% share onto the consolidated statements. So that's going to give us $42,375. So if we add it to Foxx's separate entity retained earnings plus its own share, Foxx's share of the adjusted post-acquisition retained earnings of Rabb, which is $42,375, that's our share, we're going to get consolidated retained earnings at the beginning of year 6 of $195,375. So what can we do with that? Well, like we said here, you can take that opening balance of consolidated retained earnings that you just found at the beginning of year 6, add Foxx's share of consolidated net income, which we already know from step D, right, is how much? $115,125, right? And then deduct from that $30,000 that Foxx declared to its own shareholders. How do we know that? Go back to the question. It says right here that Foxx, during year 6, declared dividends to its shareholders of $30,000. Don't forget, that is typically the way you would calculate any separate entity balance of retained earnings too, right? You would take retained earnings at the beginning plus income less dividends declared to their shareholders to get ending retained earnings. All we're doing is taking that exact same concept and applying it to the calculation of consolidated retained earnings at the end of year 6. But to do that, we needed to do another calculation and calculate consolidated retained earnings at the beginning of year 6. Add to that amount only Foxx, the parent's share of consolidated net income, and deduct the dividends that Foxx declared to its own shareholders to get to $8,500. So that kind of uses your intro financial accounting concept, right? Now, what if you don't like this way? You can go back to just starting with the ending balances of each separate entity. This is what we did in question 4 as well. Just start with the ending balances. You're given that and on the balance sheet, on the separate entity balance sheets, but you can also see it in the statement of retained earnings. The ending retained earnings of Foxx is $243. Now, the ending retained earnings of Rabb is $120, but you've got to adjust that for what amounts? For the retained earnings we'd be looking at the retained earnings at the date we became related. We wouldn't pick up that piece of that 120 because again, this 30,000 was retained earnings that was earned by Rabb, the subsidiary, before we became related to them. But don't forget, we would also have to pick up what amount. We'd also have to adjust by what other amounts. Don't forget the cumulative acquisition differential adjustments all the way to the end of year 6 and our cumulative impairment losses. So now we got to go back to that ever important step C that we did up above, and you can see that in your table. You would have cumulatively been adjusting $5,500 from years 3 to 5 and another $5,500 to the end of year 6, right? So that in total is your $11,000 adjustment that you would have made, okay, in income. You would have made adjustments from years 3 to year 5 cumulatively in income of $5,500 and one adjustment of $5,500 in year 6. So you'd have to go pick that up, right? And then don't forget, you'd also have to adjust because you're at the end of year 6 doing your calculation. You'd also have to adjust for your impairment loss. So you'd have 120 less 30 less 11 less 29 would give you 50,000. And again, because you're Foxx, you're only going to take your 75% share, and that would give you $37,500 of post-acquisition adjusted retained earnings of the sub at your share. Add it to your separate entity retained earnings at the end of year 6, and you'd get $280,500. So some students, when they see a statement of retained earnings, they say, wow, I can do it both ways to check it. Because here you see you're going to get $280,500 just as you did if you use the other way. So it is a little way to check if you're interested in doing that. Now, before we do the consolidated balance sheet, we do need to do one more calculation, and that's our calculation of NCI. Again, you can use either of the two methods that we've used in class and in the textbook. You can use the book value of net assets of Rabb plus the unallocated acquisition differential. Add those two amounts together and take the NCI share. Because don't forget, under method 1, NCI shareholders are shareholders in the sub. That's Rabb. Well, if you, as the parent, Foxx, are getting your 75% share of the investment, the value of the investment to the NCI represents the other 25% that you don't pick up. But the value of the investment is subsumed in Rabb's book value, which is the carrying value of net assets, which is in the equity section of their separate entity balance sheet at the end of December year 6, plus any of that fair value that you haven't yet allocated, right? That amount that's unallocated as of the end of year 6. Also, NCI picks up their share of that. So they pick up their share of the total here. Book value of the net assets of Rabb plus the unallocated acquisition differential. The book value of the net assets of Rabb, you can get that right from the separate entity balance sheet in the question, right? The total is $170,000. How did we get that? Well, let's go back to the question. You can see here on Rabb's statements, common shares and retained earnings. That is your $170,000. You're going to get the unallocated acquisition differential if you go back to that ever important part C. It's right here. Right there. It's $36,000 at the end of the year. So $170,000 plus $36,000 is $206. At 25%, So we know using method 1, we should have NCI at the end of year 6 for the consolidated balance sheet of $51,500. If you wanted to double check that, or if you just preferred to use method 2, you could. You can start with your NCI at acquisition, which is why I always get you to do it as part of your first step. In Part A, we did it. And you'll remember we calculated NCI using the entity theory as the implied value times the NCI share, which is 25%. And we got 39,000. So now, how are we going to get any NCI adjustments after that January 1, year 3? Well, don't forget, since the two became related up to and including the end of year 6, we have post-acquisition adjusted retained earnings of the sub, Rob, of 50,000. If you only picked up your 75% share, who do you think gets the other 25%? Bingo, NCI. So take 25% of that amount, right? 25% of that amount is going to give you 12,500. And you'll notice when you add them together, 51,500 is exactly under method 2, the balance you'd get for NCI, which matches what you'd get for method 1. So either method is okay. You use what you want. So, now, to end this piece, we're going to look at calculating the consolidated balance sheet amounts. Now again, to calculate cash and accounts receivable, that's fairly easy. All we're going to do is add the balances of Foxx to those of Rabb, and we would get 10,000 and 70,000 respectively for cash and AR. Now, here's where you had to remember one of the hints in the question, and they said the notes receivable and notes payable were intercompany. So that $40,000 receivable that's sitting on Rabb's books is from Foxx, its parent company. So we have to eliminate it. The elimination comes here against the note payable, because who's got the note payable? Foxx. So although we didn't do it or show it, you could, if you felt more comfortable, if you wanted to, you could show the worksheet entry for that. You'd have to debit the notes payable for 40,000, and you'd have to credit on the worksheet notes receivable for 40,000. And don't forget, if you check your notes or if you check the question, you're going to see in the question the note receivable is sitting on Rabb's books. And again, as I said earlier, the note payable is sitting on Foxx's. So Foxx, the parent, borrowed money from its subsidiary company, right? So we'd have to say the note payable on Foxx's book, the parent, and the note receivable on Rabb's books, the sub. So this is another way. This is another way that you could tell by looking at this worksheet entry that it doesn't go in any separate entity statements, because this is the payable of the parent company, Foxx. This is the receivable of the subsidiary company, Rabb. So it can't go in any one company's books, because any separate entity books, because Foxx has only got Foxx's account, Rabb's only got Rabb's accounts. So you can see this can only be made on the consolidation worksheet. And that justifies on the worksheet, when they post that to the worksheet, that will eliminate the account payable. There's your debit, reducing the payable, and here is your credit down here, reducing the receivable. So you're going to have nothing in the notes receivable and nothing in the notes payable. You can see with the inventory in year 6, no adjustments to make. You've got the inventory of the parent Foxx added to Rabb's to give you 110,000 on the consolidated statement. Now this can get tricky right here. That's why I said see Part C. Here we come again with that Part C. Foxx has separate entity equipment of 220,000. Rabb has separate entity equipment of 76,000. But don't forget, on the consolidated statements, if there's been any fair value increment that hasn't yet been amortized, we have to show that, because don't forget, Foxx bought fair value of Rabb, and they assess that fair value on the equipment as being higher than the carrying value that Rabb set up. So therefore, how much of that additional increment, I think it was 24,000, have we not yet amortized? Well, if you go back to Part C, that's why that section is so very, very important to you. It tells you right here, right here, it's 8,000. So we got to make sure that we pick that up, right? On the consolidated statements. So it's right here, 8,000. The land, nothing happened to that. We had the land of Foxx added to the land of Rabb, right? That's 180. The software, again, that's what's been unamortized of the increment, 8,000. And the goodwill, again, we have the recoverable amount of 20,000. If we add up all these amounts, we're going to get 702,000 for our total assets on the consolidated balance sheet. Now to turn our attention to the consolidated balance on the liability and equity side, bank indebtedness, again, we just took the parents, Foxx's, and added it to the subs, Rabb, we get 90,000. Accounts payable, the same. We've already talked about the notes payable, and again, we already know that we're only taking the common shares of the parent, right? And that's 150,000, right? Don't forget, the shareholders of Foxx are only interested in the common shares of Foxx, not the common shares of Rabb, the subsidiary, because the shareholders of Foxx are not shareholders in the sub, right? So we only take the common shares of the parent, Foxx. Now, to get our consolidated retained earnings, we already did that. We did that above, right? So if you go back up here, we did this two ways actually, right? We did it in Part F. So we're just going to see Part F right here. We did 280,500, and NCI, we already calculated that, and that's 51,500. All right. So, don't know what that's there for. Okay. So in any case, So in any case, you can see here, I just had some keying errors here, but now we've got it straightened out. I just took it from our method 1, but you could have, regardless of what method you use, and you can use any method you want in testing, you're still going to get 51.5. So if you plug that in, that's going to give you a balanced balance sheet for consolidation purposes of 702,000. Now I just made another note, as I did in previous questions, to make sure you understand why we don't include the investment in Rabb, the subsidiary account, in the subsidiary company Rabb, in the consolidated balance sheet. Don't forget, that's one of the key reasons I make you do the acquisition eliminating entry. Hopefully it sinks in that you are eliminating that account balance. So you are not including that 117,000 in your calculation, right? Or in your calculated balances for the consolidated balance sheet. It will remain, however, using the cost method, it will remain in the separate entity balance sheet of Foxx, right? As we showed you earlier. But again, in the consolidated balance sheet, it gets eliminated, right? When you take all your increments and decrements, your share of the NCI, all of that stuff. So we don't have the investment account there. So on the consolidated balance sheet. So this concludes our final presentation on the consolidation process for Foxx and Rabb. Our last video will focus on the equity method in calculating the investment in Rabb had Foxx used the equity method to record its investment.